For those of you who don't know me, I started my real estate business with just $2,500 and currently have over $30 million AUM. I left my job over 3 years ago to run my own real estate private equity firm full time. And given the deal sizes I'm looking at now, between $10 million and $50 million, my 3 to 5 year goal is to deploy $100 million in investor equity per year into real estate, which should be hard but achievable. This video will be about real estate, but in reality, it's mainly a video about making money. I've always wanted to make a lot of money, and in my opinion, real estate is simply the best way to do that. I was once where I'm sure many of you are now, at a W-2 job and in search of the best way to break out and start making real money. I chose real estate as my way out and have done quite well since then. In this video, I'm going to explain to you, one, why I think real estate is the best asset class to make money in, basically why I chose real estate, and two, how to get rich in commercial real estate without any stupid gimmicks, basically how you can get rich in real estate yourself. Let's get into it. Why I think real estate is the best asset class to make money in. Since you clicked on this video, I'm sure you're all interested in getting rich. At this point in your life, you should have realized that the only way to get rich is by owning equity. That means you either have to own a business or invest in a business. No other options. If you want to get rich, it's one of those two things. Real estate confuses a lot of people, mainly because it's so tangible. It's an actual physical building. This makes them think that it's not a business. But real estate at its core is just a business. And like every other business, it can be bought, sold, and flipped for a lot of money. Why is this important? Because buying and selling businesses, basically private equity, is the best business model in the world, and real estate is the best business to buy and sell. Before I get into why real estate specifically is such a good business to buy and sell, let's talk about why private equity is such a good business model. The normal way to gain equity is to start a business from scratch. This requires working like a dog for 3+ years while making minimal money to get the business up and running. Does this work in the long run? Absolutely. Is it the most efficient way to make money? Absolutely not. Private equity, on the other hand, involves buying an already successful business and simply tweaking it to improve operations. This is significantly less risky and can have a way shorter time horizon because you get to skip that tough sledding beginning phase. Far better model than starting a business from scratch. There's a reason why private equity investors all have beach houses. Since all real estate deals are already currently operational businesses, aside from true development deals, all real estate deals are technically private equity deals, which means that you always get to skip that start a business from scratch phase. So what is it about real estate specifically that makes it such a good business to flip? One, it's probably the easiest business in the world to manage. Why is that? Well, the hardest part of any business by far is generating leads. And by that, I mean customers. Multifamily real estate has the benefit of having the single most built-in demand of any business on the planet. People literally need a place to live, which makes lead generation incredibly easy. And this sounds cliche, but it's true. The leads come to you and the problems are generally simple to solve. This is why third-party management is so common in real estate, but so uncommon in other businesses, right? You can outsource management with only a small drop-off in quality in multifamily real estate, but if you outsource the management in most other businesses, it'd be a complete disaster. Just goes to show you how easy it is to manage. Two, it trades for roughly a 15x sale multiple. Most private businesses trade for roughly 5x. Real estate trades for significantly higher. This means that small increases in NOI, right, which is the real estate version of EBITDA, result in huge increases to property value. If you increase the EBITDA of a property by just, or EBITDA or NOI by just 2K a month, which isn't hard to do at all, you put 360K of profit into your pocket, right? 24K times 15x multiple. If you add value to a different private business, that same 2K a month in EBITDA you added only puts 120K of profit in your pocket, right? 24K times a 5x multiple. So your time is worth 3 times more adding value to real estate than it is adding value to most other private asset classes. This is really important. I don't think people value their time right. It's a lot easier. 3, repeatable value add process. In real estate, the units in the building are typically identical. So if you buy a 50-unit deal, every unit is nearly the same, right? One might be 1 bed, one might be 2 bed, but they're nearly the same. This makes the value add process incredibly easy. Once you figure out how to add value to one unit, you now know the exact process, cost, and return on investment to doing it for the other 49 units, and you can rinse and repeat. Other asset classes are far harder to add value to because the process is not identical as it scales. Actually, it changes a lot. 4, most liquid asset class in the private markets. This is important when you're buying and selling. If you want to get rich, you're going to have to own a business, and starting a business takes a lot of time. So it's far easier to simply buy an existing business, add value, than to then sell. The selling part is important. You need a liquid market to do it. There are a lot of businesses that are hard to sell, and that's pretty much every other business, small business really, aside from real estate. This includes service businesses, e-commerce businesses, et cetera, which makes running a private equity process very difficult, right? Real estate of the private assets is probably the most liquid, and you want a liquid asset class where you can get in and get out quickly to execute any sort of private equity strategy. 5, incredible tax treatment. Real estate gets the best tax treatment out of any asset class in the country. On a sale, you can 1031 and pay no taxes. On a refinance, you can pull out your money and pay no taxes. If you choose to pursue real estate full time, you can get real estate professional tax status, which means that you use depreciation from your deals against your active income, which basically means that you'll never pay tax again, even if you're making millions of dollars a year in active income. It's insane that more people don't know about this. Real estate is the only asset class, where you can legitimately, legally not pay taxes for the rest of your life. In my opinion, all of these qualities, right, and attributes make real estate the easiest and best business to get rich in, which is why I chose it to pursue a career in. How to get rich in real estate. A lot of people have misconceptions about real estate. Some people think it's unattractive because they get caught up in the cash flow. They think the cash flow can be low. And they're actually right. The cash flow in real estate is nothing special. But cash flow isn't how you make real money in real estate. The real money in real estate is made through buying, adding value, and then selling. It's not made through the cash flow, and it's not made through appreciation. I know this is a framework switch for a lot of you. So how does this process work? It's very simple. You buy, get the stabilized yield over the market cap rate, then you sell. Before I get into how this works, let me define a few terms. NOI is revenue minus expenses. Like I said before, it's essentially the same thing as EBITDA. Market cap rate. Cap rates are how properties are valued in real estate. Cap rate equals NOI divided by purchase price. For those of you in the regular private equity space, it's essentially the inverse of an EBITDA multiple. A 5% cap rate equals a 20x EBITDA multiple. The market cap rate is the average cap rate deals sell for in the market. For those of you in the regular private equity space, you could think of this as the industry EBITDA multiple deals sell for. Stabilized yield. The stabilized NOI, after all renovations have been completed, divided by all your costs in the deal, the purchase price, the deal cost, the renovations, etc. That's your stabilized yield. This tells you how your deal is performing relative to the market. If you stabilize above the market cap rate, you sell back to the market for the market cap rate and you make money. If you stabilize below the market cap rate, the market values the deal at less than your yield, which means you're going to lose money on the deal. This is easiest shown through an example. Let's say you buy a 4-unit multifamily deal for $500K. The market cap rate is 6%. So that's the average cap rate deals trade for in the market. You buy the deal for a 6% cap rate, right? The market cap rate, which means that the NOI was 30K, right? 500K times 6%. You invest 75K into renovations and are able to increase the NOI by 15K to 45K. So your basis in the deal is now 575K and your new NOI is 45K, which gives you a stabilized yield of 7.8%, right? 45K divided by 575K. That's a 180 basis point spread over the market cap rate of 6%. So you now have a business with a cash flow stream of 45K that the market values at a 6% cap rate. So 45K NOI divided by that 6% market cap rate equals 750K. Your total basis in the deal is 575K. The business is now worth 750K. You net 175K in profit on the deal. Rinse and repeat. Yes, in this example, I'm ignoring transaction costs here to make it easier to understand. In a real scenario, the numbers would be slightly different. This is how you make real money in real estate. You buy the deal, get your personal stabilized yield at least 150 basis points above the market cap rate, then you sell the deal back to the market at the market cap rate. Of course, there are more things to look at when analyzing a deal. Your entry basis, your exit basis, your DSCR, etc. But at its core, it's a very simple business once you start focusing solely on the spread between your stabilized yield and the market cap rate. A small deal like this, at 4 units, only takes a month, maybe a few months at max to renovate, and you could be in and out in the deal in under a year. The two biggest misconceptions in real estate are that you only make money through cash flow or through getting lucky with appreciation, which would be market rents increasing. All of that is helpful, but none of that is necessary. Once you learn this process, you don't have to rely on cash flow to make money, and you don't have to rely on the market to make money. You can use your own skills to add the value yourself. I know this sounds daunting, but if you take it day by day and you scale, it really isn't. My first deal was a 200K triplex that I only had $2,500 of my own money to invest in. Then I bought a 16-unit deal. Then I scaled up and up, getting bigger and bigger. The last deal I just closed on was $16 million. Now I'm looking at $20 to $30 million deals. It all compounds. My advice to anyone looking to get started in real estate is to get started immediately. Real estate is not a get-rich-quick business. The earlier you start, the closer you are to making real money. The real money isn't made on the first deal. It's made on the 3rd, 4th, 5th, and 6th deals. That same math that netted you 175K profit on a 4-unit deal will net you 1.75 million on a 40-unit deal, as long as you stay the course. In this business, everything compounds. Your relationships with brokers compound, your relationships with lenders compound, your relationships with investors compound, your market knowledge compounds. If you're making more than a couple $100,000 per year for your first few years, I'd be shocked. But if you're making less than $500,000 per year 10 years in, I'd also be shocked. There are very few people who stay in for the long haul and don't take on a stupid amount of debt who don't do extremely well in the field. To summarize this video, you need to own equity to get rich. Private equity is the best way to own equity because instead of having to start a business from scratch and barely scrape by for 3 years, you can save time and simply tweak, improve an existing business instead. Real estate is the easiest / really best asset to operate a private equity model in because it's easy to manage, trades for a high multiple, it's financeable, has a repeatable value add process, is relatively liquid for a private asset class, and has the best tax treatment out of any asset class. Once you learn how to bring your stabilized yield above the market cap rate, you can consistently generate large payouts in an extremely low risk asset class, even while still at your W-2 job. You want to reframe your mindset from thinking of real estate as a cash flow business to thinking of real estate as the best vehicle to create your own private equity firm, which is the best vehicle for creating wealth. If you'd like to learn how to build your own real estate portfolio and escape your W-2, in addition to running my own private equity firm, I teach others how to as well. It's an 8-week program and it's all one-on-one with me. Given the one-on-one time, spots are limited and it's first come, first serve. To apply, click on the link in bio.